Hello, welcome to La Excellence. Welcome to Laex Prelims Marathon series. In this series, we are going to take up part 2 of important economy related terminology in news. In part 1, we have completed 30 important terms that are in news. In this session, we are going to complete the remaining 25 terms. With that, overall 55 terms we are covering from the economy. The PDF of this video is uploaded in the description link. Please go through that once. Let's understand the first term in this series. First one is Operation Twist. What is the meaning of Operation Twist? See, RBI last year and this year has gone for this Operation Twist wherein it has replaced the long-term bonds, long-term government securities with short-term bonds. Why? Long-term bonds were issued earlier when the interest rate was high. Based on the long-term bonds and the interest rates, banks decide their interest rates. As the long-term bonds and the interest rate mentioned on them is more, interest rates charged by the banks is also more because interest rates are indexed to the long-term bonds. Now what the government wants to do? Government wants to reduce the interest rates because it increases the money supply. That's why RBI is taking certain measures. RBI said, so sell the long-term bonds and buy the same worth of short-term bonds so that short-term bonds will have the same interest rate. Remember, short-term bonds also will have the same interest rate. Otherwise, if interest rate is less, why will they buy? They will keep the long-term bonds only. So they say that we will return the money in this period, let's say 1 year, 3 years. So sell these bonds and purchase these bonds. That way RBI sold the short-term bonds and purchased the long-term bonds, and long-term bonds interest rate is now reduced because long-term bonds existing in the markets is less. That way it is facilitating the reduction in the interest rates from the banks. For that purpose, it has gone for Operation Twist. Operation Twist, read it once. Simultaneous selling of short-term securities and buying the long-term securities through open market operations, OMOs, open market operations. It is done to bring down the long-term interest rate and increase the short-term rates, increase the short-term interest rate. Under this mechanism, short-term securities are transitioned into long-term securities. That's it. Central bank buys long-term and their demand rises and it increases the prices in the market. That way government through RBI is trying to increase the money supply. And remember, there is a committee called Monetary Policy Committee. Monetary Policy Committee decides on the repo rates, reverse repo rates. These are called policy rates. There is this committee called Monetary Policy Committee which decides these rates. Earlier RBI used to decide these rates. In 2014 there is this committee called Urjit Patel Committee. Based on the committee's recommendations, Monetary Policy Committee was appointed. This fixes the benchmark interest rates of the RBI and it sets the inflation targets. And as of now this committee consists of 6 members, 3 from the government, 3 from the RBI, including the RBI governor. In case of any tie in the decisions of these 6 members, RBI governor's decision is final in this Monetary Policy Committee. Open market operations, OMOs, are not under this Monetary Policy Committee. These are by the RBI itself. Monetary Policy Committee decides repo and reverse repo. The next important term is Basel III Norms. What is the meaning of Basel? Basel is a place. So Basel III Norms. Basel norms are internationally agreed norms. There is a committee called Basel Committee on Bank Supervision. This committee, as a response to the financial crisis of 2007 and 9, Basel III norms are proposed. We earlier had Basel I norms, Basel II norms, and we are implementing Basel II norms at present. Basel III norms are already proposed. Many countries are implementing them. India has not yet adopted Basel III completely. We are still under Basel II norms. What is the importance of Basel norms? It is to strengthen the regulation and supervision and risk management of banks. There is the ratio called capital adequacy ratio, wherein overall risk weighted assets, compared to the overall risk weighted assets, we need to place certain money, certain percentage of fund to handle the risk arising from the risk weighted assets. Here assets means loans. For a bank, remember, assets are loans, liabilities are deposits. Yes or no? Liabilities are deposits. Okay. Now this Basel Committee on Banking Supervision members are committed for implementing this one. India is part of this Basel Committee on Banking Supervision. India is already implementing Basel norms, and now we are slowly transitioning into Basel III. Basel 1, Basel 2 and Basel 3, there is this ratio called capital adequacy ratio that is decided at 8% of the total risk weighted assets. So that India is already maintaining. Apart from them, there are other things that we need to comply with, which are part of Basel 3. The next important issue that is in news is Purchasers Managers Index. What is this Purchasers Managers Index? To measure the industrial activity, we have IIP, which is released by the NSO, National Statistics Office, released the monthly index of industrial production. This says about the industrial activity in the country over that particular month. But there is this Purchasers Managers Index, which is measured from the manager's point of view. This is for the upcoming month. IIP is for the past month, but this Purchasers Managers Index is for the next coming months. So how are they expecting the economy to be performed? So how are the market conditions going to be? That is measured under Purchasers Managers Index. This Purchasers Managers Index is a number from 0 to 100. If it is more than 50, there is expansion in the market. In the previous months compared to previous months, this month there is expansion. So if it is 50, if it is less than 50, contraction. If it is equal to 50, no change. So based on PMI of the previous month, we calculate the current month. That's the difference. See, while calculating IIP, we use the month of last year, that is August 2019 and August 2020, and then we compare. But in Purchasers Managers Index, we use the last month of this year, that is August 2020 and September 2020, then we give the ranking. That way, Purchasers Managers Index, and these are different. Who calculates PMI in India? This PMI data is published by this Japanese firm Nikkei. So this is a private company. Purchasers Managers Index is widely used among the manufacturers, but IIP is the official statistic that we use. Remember that. In IIP, there is a subgroup called core sector. There are 8 core sectors. You need to remember which one has more weightage, and core sector overall weightage is 40.8% out of total IIP. That also we should remember. The next important term is moratorium. What is moratorium? It is simply postponing the loan repayments. It is a legal authorization provided for postponement of a loan repayment for a predetermined period, let's say 3 months, 4 months, 6 months, like that. So why is this in news? So banks are offering moratorium for us, for individuals, but banks are not willing to offer the moratorium to NBFCs, that's non-banking financial companies, because they fear that might lead to NPAs, non-performing assets. But if they are not offering any of the moratorium, NBFCs are going to face the liquidity problem. Already NBFCs are under losses before this COVID-19. Now this is going to increase the pressure on these NBFCs. That's the problem. Now RBI has asked all the banks, cooperatives, NBFCs offer a 3-month moratorium on the principal as well as the interest. Remember, for the EMIs that we need to pay for these months, we need to repay them with the interest in these 3 months also. The next important term is social stock exchange. What is this social stock exchange? There are certain companies which are called social enterprises. These are not for profit organizations. These are voluntary welfare organizations, but they require money. Any organization, whether it is charitable or economical, whatever, they require money to operate. For that purpose, they need to raise the capital. There is this platform provided through SEBI in the last year's budget 2019-20 that is called Social Stock Exchange. This is an initiative to help the social and voluntary organizations to gather the money. It increases the transparency because those who are investing in these agencies, they will ask, okay, are you being transparent or not? So like that, transparency increases. And who manages these social stock exchanges? SEBI, Securities Exchange Board of India itself manages social stock exchanges. Next one is digital services tax. What is this digital service tax? These are the taxes that are imposed on the digital services such as companies like Google, Amazon, Apple. These are digital service companies. Many countries call this as GAFA tax. Google, Apple, Facebook, Amazon, like that. The GAFA. So GAFA tax, informal name. But in India, we have imposed digital services tax. This is not the first time that we imposed the digital services tax. In 2016 itself, for the first time in the world, India has imposed a tax called equalization levy. Equalization levy is a digital services tax. What is this? If there are any advertising companies which are using digital services, let's say if there is any company that went on advertising in Facebook or Google somewhere. So they are paying some money to Google or Facebook, yes or no? On that money, Google or Facebook are earning revenues. When they are earning the revenues, they need to pay the tax, yes or no? Otherwise, if there are any local companies, on the income that they are earning, they are paying the taxes. As these are MNCs, multinational companies, their companies are registered in other countries, they are not paying the taxes. To avoid the tax evasion, in 2016 budget itself, Indian government has introduced equalization levy at the rate of 6%. 6% of total profits that they receive from this advertisement revenue, they need to pay to the government, central government. Now in this budget, digital services tax as a tax, separate tax is proposed. This tax applies only to non-resident companies with annual revenues more than $267,000 and they cover online sales of goods and services in person in India. Then only this tax is applicable. This digital services tax is applicable to e-commerce companies also. So recently what has happened is USA said we are going to inquire about the taxation that you are imposing. Your tax like digital service tax is impacting our MNCs. That's how USA has criticized India and India has imposed it in this year's budget. That's why this is in news. Let's understand what is GAFA tax. GAFA is named as Google, Apple, Facebook, Amazon. As we just told you, this is a digital service tax with a different name. Different European countries they are going for imposing these taxes. And these MNCs, Google, Apple, Facebook, Amazon, big major companies. That means the tax is not just on these 4 companies. Like this, there are many companies. On them, these countries are imposing the tax which is called as GAFA tax. The next term is direct monetization. What is the meaning of direct monetization? See, monetization of deficit. Government requires money. For that, monetizing means printing money. Printing money. Direct monetization, indirect monetization. Likewise, there are 2 terms. RBI directly funds the central government to fill its deficit through against the government bonds and securities. That's called direct monetization. Until 1997, government used to sell the securities directly to the RBI and then is going to get the money. And there's one more way of monetization that is called indirect monetization, wherein RBI sells the government bonds through open market operations or purchases bonds from the open market operations. And that way, it monetizes the deficit. That is considered as indirect monetization. Direct monetization means take the bonds, print money. That's called direct monetization. Why is that used? That is used to fill the deficit. That is called as deficit financing. Filling the deficits using different means is called deficit financing. Deficit financing is done through various means: net market borrowings, using state provident funds, external debt, securities against small savings, other receipts, etc. There are certain merits and demerits to deficit financing. What are these merits? What are the demerits? Please go through them once. Important. See here, there are different types of deficits that are mentioned. Revenue deficit, effective revenue deficit, fiscal deficit, primary deficit. Please go to your economy book and read the basics on them. Remember, deficits as a concept is very important. The next important topic is minimum operating price. What is this? This is in news. There are retailers who have requested the Commerce Ministry to fix the minimum operating price for the online sellers. What is happening is the e-commerce companies and online sellers, as they have deep pockets, that means as they have more money, they are selling the goods and goods especially at very lower prices, at deep discounts. They are offering the deep discounts which cannot be borne by at the same price the retailers cannot sell. So under such circumstances, they have asked and requested the Commerce Ministry, if you are not going to take the action, we are going to lose the income. Please take some action. There is this maximum retail price. Similarly, please fix the minimum operating price. Minimum operating price is the lowest price at which a retailer can sell a product and is set by the brand or the manufacturers. That's called minimum operating price. And Commerce Ministry Commerce Ministry is the nodal agency for this e-commerce. That's why they all went and requested the Commerce Ministry. And remember, e-commerce is under which ministry? Commerce and Industry Ministry. And there is this department called Department for Promoting Industry and Internal Trade. Under this particular department, e-commerce sector is regulated. The next term is headline inflation. It is a measure of total inflation within a country. So that's called headline inflation. It includes food and energy. If we exclude food and energy, that is called as core inflation. If we include them, this is called as headline inflation. Earlier, headline inflation used to be calculated with wholesale price index. From 2014 onwards, we are using consumer price index. Now it is not wholesale price index, it is consumer price index. Very important. Let's understand the differences between WPI and CPI. So I assume that most of you know these differences. Please go through them once. So average change at the wholesale level, average price change at the retailer level. It is published by the Commerce Ministry under Office of Economic Advisor. It is published by the National Statistics Office under Ministry of Statistics and Program Implementation. It measures only goods. It measures, CPI measures goods and services. It considers 697 items, goods, and it considers 448 in rural, 460 in urban areas. It provides CPI urban, CPI rural separate indicators, and then CPI all India indicators. Right, base year is 2011 and 12. This base year is 2012. It releases the inflation rates on weekly basis for primary articles and fuels, and aggregately at the monthly level. CPI is released only at the monthly level, and this is considered as headline inflation now. Important. The next important term is hybrid annuity model. Why is this in news? Because Indian roadways, especially in the National Highways project, hybrid annuity model has worked and it has led to the success in the recent days. That's why this is in news. What is this? This is a mix of engineering, procurement, construction, and then build, operate and transfer models. These are PPP models, public-private partnership models. Under this model, first government pay the private company 40%, and then remaining 60% is paid in the form of variable annuity. Annuity means variable money upon the collection of cess, etc. Earlier, what was the thing? You build, operate, get the money and transfer. And under such circumstances, sometimes, let's say for 15 years, they are given for the lease. And in the 15 years, if they are unable to get the money that they are promised, all these private companies are going into NPAs, and then they are not coming forward for the further projects. That's why hybrid annuity model, wherein 40% is paid by the government directly to the company, and then remaining amount by the cess, by the toll, etc. That way they are getting it. This hybrid annuity model was brought in the year 2015 to encourage the private participation, and it has served in the past few years, and then lending for the projects has become a very good thing, and it has become a successful model. The next important term is income distance. This we read under Finance Commission transfers. There is Finance Commission under our Constitution, Article 280. This is appointed once in 5 years. This shares the income from center to states. That is called net divisible tax income. So that income is shared between center to state, which is called as vertical devolution. Vertical devolution. And then let's say now 41% amount is shared. This amount need to be shared again among the states SRO. So that kind of sharing is called, this is called vertical, this is called horizontal devolution of money. Finance Commission formulates a specific formula for distributing this money between the states. In that formula, there is this important term called income distance. Income distance is defined this way. The highest per capita state among all the states is considered highest per capita income, and other states are compared with it. Let's say there is this state highest per capita, it is compared with the other state lesser income. This gap is called income distance. Based on the difference between this, or based on the income difference, Finance Commission grants are given. There is 45% weightage given to this fiscal or income distance. States with lower per capita income, they are getting more money because that is given more weightage. Less per capita, high per capita, distance is more. As distance is more grants under or more devolution under Finance Commission. So this is the 15th Finance Commission criteria on devolution. Income distance 45%, 2011 census population 15%, forest cover and ecology 10%, demographic performance 12.5%, tax contribution 2.5%, area 15%. That means this is the first one. These two have equal weightage, some population and area, and then highest weightage is given to demographic performance, and then to forest cover, finally to tax contribution. Tax contribution is added. That's an important change. The next important term is power purchasing agreements. What are these power purchasing agreements? It is a contract between power generators and power purchasing companies. That means power generating GENCOs, generating companies, and power distributing DISCOMs. This is an agreement. So these agreements are in news because some states have cancelled the power purchasing agreements in between. And there is this electricity bill 2019. This electricity bill was proposed, not yet passed, but it is a draft bill. In that bill, there is this particular contract enforcement authority, central contract enforcement authority, that is proposed to enforce these power purchasing agreement contracts. And many states have opposed it. That's why this is the news. Right, this power purchasing agreement, this defines all the commercial terms for the sale of electricity between two parties, including when the project begins at the commercial scale. Right, power purchasing agreements. And renewable energy, for renewable energy like wind and solar, power purchasing agreements are mandatory for the local distribution companies. They need to buy the power from these renewable energy companies. The next important term is incremental capital output ratio. Incremental capital output ratio. That means with one more unit of capital, how much output increases. 1 unit of capital leads to how many units of output. So if it is more capital is required, then it is bad in the economy. If less capital is required to produce one more unit of output, that is considered as an efficient economy. So for that, there is this is the metric. I-COR, incremental capital output ratio, is a metric that assesses the marginal amount of investment capital that is necessary for producing one more unit. So that's considered as a tool. This is used as a tool which explains the relationship between the level of investment made in the economy and consequent increase in the GDP. A lower COR is preferred. Yes or no? Lower COR is preferred and higher COR is considered bad. Higher COR is bad, lower COR is good. This is important. Often such basic questions are asked in the UPSC exam. Please go through such indices etc. carefully. The next important term is Goldilocks economy. Goldilocks as a term is often used in S&T. So Goldilocks zone, that's the name that's used in S&T. Goldilocks zone is a zone where habitability of life is possible. That means which are considerably warm but which are not extremely warm, extremely cold, which have warm climate, not hot and cold. Such zones are called in general Goldilocks zones. Here Goldilocks economy means an economy which is not too hot or too cold. That means there are certain economies which grow very faster and which come down very faster. Such things should be avoided. There should be moderate economic growth with moderate inflation and market-friendly monetary policy. Such economies are called as Goldilocks economies. So it is warm enough for this steady economic growth, not a sudden rise and sudden fall, but steady economic growth. The next important term is regulatory sandbox. Regulatory sandbox usually refers to testing of products, live testing of products. Recently, SEBI, RBI, there are many regulators. It's not just SEBI, it's not just RBI. SEBI, RBI and many other regulators, they allow for certain products under their domain to be tested. There are digital products which are increasing now. So they provide regulatory relaxations to these kind of innovations. For testing, they provide regulatory relaxations. These are called regulatory sandbox. The objective is to foster responsible innovation in financial services and to promote efficiency and to bring the benefits to the consumer. This regulatory sandbox, it is a positive step for the financial technology in India. That is to encourage the fintech. Regulatory sandbox is provided. RBI has issued many instruments under this. SEBI has also last year proposed for regulatory sandbox and many initiatives under that. The next important word or term is time bank. What is this time bank? We know that Madhya Pradesh has a separate department for happiness. So happiness department, and it is planning to set up a time bank. Time bank means instead of having a repository of money, it has a repository of time. That is, it will lend currency to an hour. That means more hours work, more of value, something like that. So the core value behind this particular concept is instead of using paper money, use the time. For example, more amount of skill, so more amount of training, something like that. This kind of time bank was proposed earlier, but first implemented in Japan in 1973. This Madhya Pradesh government is trying to go for this. The next important term is willful defaulter. What is this? A person who takes the loan but is not paying back willfully. Though having the ability to repay, the person is not paying. That kind of thing is called willful defaulter. According to the RBI, willful defaulters and their numbers are increasing. Willful defaulters number in the last 5 years has increased. That's the issue. And if a person is declared as a willful defaulter by the RBI, under SEBI regulations, the person or his company cannot access the capital markets. In addition, under Insolvency and Bankruptcy Code, they won't have any resolution plan. And there is this act called Fugitive Economic Offenders Act. Under this willful defaulter, if he or she crosses India and reaches to other country and is not willing to come back, the person is declared as fugitive economic offender and his property can be confiscated. So Vijay Mallya is the first person who is declared as fugitive economic offender under this particular act. After that, Nirav Modi was declared as fugitive economic offender. Right? Willful defaulter. This problem is increasing. Next important term is rating agencies. What is this? Recently, central government has told that if we take more loans, rating agencies are going to reduce the rating. So please take the loans. That's how central government has told to the states. Yes or no? Then what are these rating agencies? Rating agency is simply a company which assesses the financial strength of companies, government entities in a country. Credit rating agencies, what do? They provide the efficiency, because if I want to invest in a company, if I know their credit rating, okay, I will think, okay, this there I can invest. For that, credit rating agencies are very important. SEBI, Securities Exchange Board of India, this regulates the credit rating agencies in India. There are international credit rating agencies called Moody's, Fitch, S&P, and there are Indian credit ratings called I-COR, CARE, Fitch India, etc. These are all Indian credit rating agencies. These credit rating agencies, yes, they help in this way. But if they take money and if they give more rating to a company, what happens? So that's called malpractice. Such things are regulated under SEBI. The next important term is middle income trap. What is this middle income trap? A country rapidly grows to a certain level. After that, after reaching lower or upper middle income status, it is unable to move to further stages. That condition is called middle income trap. Read the statement here. It refers to countries that have experienced rapid growth and quickly reach the middle income status. Middle income status is defined by the World Bank with the gross national product per capita. So they are unable to achieve the higher status. So middle income trap is a relatively new phenomena mentioned recently in 2007. In this idea, middle income countries are trapped like that. So they have lost the export potential, they have lost the edge in the export potential. Earlier, as they had export potential, more edge over export potential, their growth increased rapidly, but now suddenly they got struck at that level. Singapore, etc., they are in middle income trap. Next important term is foreign exchange reserves. So recently what has happened? Forex reserves amount has increased. In spite of less trade, forex reserves have reached a highest level, $445 billion level it has reached. So why? Because our oil imports reduced. That means imports reduced, of course exports also reduced. But the reduction in the imports is more. Because of that, the forex reserves have accumulated with the central bank, that is RBI. Forex reserves are the assets or reserves that are held by the central bank in the form of foreign currencies, which includes bonds, treasury bills and other government securities. Forex reserves also include gold, currencies, IMFs, SDR, special drawing rights. All these are part of forex reserves. Forex reserve includes foreign currency, but it is not the only component. There are other components in forex reserves. Please remember that. These assets serve many purposes, especially it acts as a backup to the imports and it stabilizes the national currency. A rise in forex reserves will give the central bank a levy against any sharp decrease in the rupee value. Because when the forex reserves are less, our rupee depreciates rapidly. Earlier our rupee depreciation was huge, but now because of this increase in the forex reserves, rupee depreciation also got stabilized. That's the issue over here. The next important topic is tax amnesty. Tax system in the indirect tax system or in the direct tax system providing amnesty. Amnesty means if there are any pendings, if there are any complaints on them, forgiving and giving them a chance to move clean. So that's called tax amnesty. So it is a limited time opportunity for specific group of taxpayers to pay a defined amount in exchange for forgiveness for tax liability. This is called tax amnesty. Last year, our government has brought in the Sabka Vikas Legacy Dispute Resolution Scheme. Sabka Vikas Legacy Dispute Resolution Scheme 2019. This is for indirect taxes that are in pending. So for that, this scheme was brought in. And this year, Vivad Se Vishwas Scheme 2020, This is to deal with the direct taxes and dependings. Under these, government has asked them to pay certain amount without any fine, etc., by a certain time limit. Such things are called tax amnesty. To settle direct tax disputes, indirect tax disputes, these schemes are brought in. This confers the immunity from the prosecution, but these are for limited time only. For example, if they say we didn't disclose this income, we are now paying the taxes. So they are not going to be arrested. They are going to be given amnesty, penalty and interest. These won't be there if they pay the tax now in the specified period of time, but this is a one-time scheme, remember. Sabka Vikas Legacy Dispute Resolution Scheme, Vivad Se Vishwas Scheme 2020. Vivad Se Vishwas this year is direct taxes, last year's scheme was for indirect taxes. And this is about the scheme, please go through it once. Direct tax and Sabka Vikas Legacy Dispute Resolution for indirect tax. Next important term is currency swap agreement. Recently, RBI and Sri Lankan central government have made an MOU on transferring some amount under this currency swap agreement. What is the meaning of currency swap? Swap means exchange. Currency swap between two countries as a contract. Two countries as a contract under certain terms is given because forex reserves are required for all countries for their imports. When the forex reserves are not in a sufficient amount, then they are going to take the money. Then they are going to take the help of other countries, wherein countries make such agreements, currency swap agreements. We have many agreements with other countries. With Japan, we have currency swap agreements. With Sri Lanka, recently India made a currency swap agreement. So this is not a new one. Remember, banks and governments engage in currency swaps with foreign counterparts to meet short-term foreign exchange liquidity. For example, here Sri Lanka's economy depends upon tourism. So because of this corona, etc., tourism sector got impacted. So forex reserves for that country were less. Because of that, what has happened? They are in shortfall. That's why they have got the money through currency swap agreement. The next important word is recapitalization. Here means again, capitalization means giving money. Bank recapitalization is the word. Bank recapitalization means infusing more money in a state-run bank so that they meet the capital adequacy norms. While reading Basel norms, you remember? We read about capital adequacy norm, CAR, 8%, remember? So, to meet such requirements, sometimes bank doesn't have money because of the NPAs and other problems. In certain cases, government infuses some money because these are government-run banks. Government doesn't infuse money into the private and foreign banks. It infuses money only to the public sector banks. It helps them in managing the liquidity situation. Bank recapitalization bonds as an idea was proposed recently. What is this? To recapitalize, some money has to be allocated under the budget. Yes or no by the government. But already government is facing fund issues. That's why they said, we are going to issue a bond wherein people invest in these bonds. You use this money for recapitalization and pay it back after some time. That kind of bank recapitalization bonds, this is in use. This allows the government to maintain the fiscal deficit targets as well as provides the money flow into the bank system. So recently, for regional rural banks, RRBs, for regional rural bank recapitalization was done. That's why that word was in use. Right, RRBs were established in 1975 through ordinance. After that, there is this particular act, RBI Act 1976. Under that, RBIs are given statutory status. RRBs are owned by three entities. Central government with 50% share, state government with 15% share, sponsor bank with 35% share. Right? These banks, they work under NABARD. They are under the regulatory control of NABARD. These are for rural development. But then there are certain banks called cooperative banks. What are these cooperative banks? What are the differences between cooperative banks and RRBs? Ownership. In cooperative bank, whoever is taking loans, that is in the local area, owners, people invest and then people only take the loans. That means local people come together, they form the cooperatives and then they invest the money, and these are funded by the local governments also. So RRBs but are funded by the three different bodies. That's the primary difference. Second one, RRBs are directly regulated under the NABARD, but other banks, especially other banks, are regulated under RBI. Of course, NABARD is again regulated under RBI. What is the statutory background? So these two banks have distinct laws. Regional Rural Bank Act 1976 and then Cooperative Banks Act. So two different laws. Statutory provisions, CRR, cash reserve ratio, statutory liquidity ratio, these are not applicable for the RRBs. These are not applicable to RRBs, and cooperative banks doesn't come under scheduled banks. Cooperative banks are a separate category. For all the scheduled banks, scheduled commercial banks, scheduled cooperative banks, these are not commercial banks, so SLR CRR doesn't apply for them. But scheduled commercial banks, SLR CRR, these norms are applicable. Though RRBs are scheduled commercial banks, as they are under a different setup, SLR CRR norms are not applicable to RRBs. The next important term, GST Compensation Cess, very important. What is the meaning of cess? Cess is the additional tax imposed on the GST for a specific purpose. What is that specific purpose? To compensate the losses for the states. Yes or no? Cess has a specific purpose. And then there is one more tax called surcharge. This is also an additional charge, additional tax over the tax. But surcharge doesn't have any purpose specification, no purpose. But then cess has a specific purpose. This cess is to compensate the loss of revenue to the states for implementing the GST. There is this particular act called GST Compensation to States Act. Under this act, compensation levy is imposed on various goods, and this amount is transferred for the states in case of loss. For the 5 years, it is promised. For the 5 years, starting from 2017, in case of loss of revenue to the states, the central government said we will compensate you using this particular cess. But recently, why this is in news? From this cess, funds are diverted. That is one issue. Second issue, compensation cess is not sufficient, so we are unable to pay you the compensation. Please borrow the money. Later we will pay the money. That's the argument of central government. Because of these two things, compensation cess, GST compensation cess is in news. Let's understand GST. GST is an example for cooperative federalism. This was brought in under 101 Constitutional Amendment Act. There is this GST Act 2017. GST Compensation to States Act 2017 for 5 years starting from 2017, right? Compared to 2015 and 16 average tax, if there is any loss, then states will be compensated. And there is a council called GST Council. This is a constitutional body which consists of states and center. Center and state representation is there in the GST Council. Very important. Please go through it once in detail in your polity. We have recorded a video on constitutional bodies. Please go through that also. That's available in the Prelims Marathon playlist. Right, let's understand the features of the GST. Please read about them. GST network, input tax credit. These are very important concepts. I assume that these need not be explained, at least at this stage. So please go through them once and understand the advantages of GST. Our final topic and the term is trade barriers. What are these trade barriers? When two countries trade, they exchange goods and services, especially this is related to goods. While exchanging the goods, a country imposes tariffs. Tariff means a kind of tax. So that is called a tariff barrier. Then there are other barriers called non-tariff barriers, which include import quotas, embargoes, binational kind of regulations, exchange controls. These all impose the barriers to the trade. These trade barriers, they reduce the free flow of trade between the countries. And there is this organization, WTO, which formulates the rules and guidelines on tariff and non-tariff barriers. Removal of tariff barriers promotes free and fair trade. Recently, what has happened? World Bank has provided $1 billion loan to India, and then it said that don't keep any trade barriers. With this money, when you purchase, don't keep any trade barrier, make it universal applicability. Any company can sell the products with this, for example, if the country is buying ventilators with this $1 billion money. So it cannot say that only from Indian companies we are going to buy. No, World Bank said it should be applicable universally. That means foreign companies also can come and bid for such procurements. So that's called trade barriers. Very important. There is a term called free trade agreement. Under free trade agreements, trade barriers would be less. That's about the 55 terms, important terms that are in use for our prelims examination. PDF is available for this in the description link. Please go through it once. All the very best. Thank you very much.